Good morning and welcome to Weekly Insights by John Plassard with Cité Gestion. 2026 does not open with a monetary shock, but with a change in market mechanics. Interest rates have already peaked and started to ease, while liquidity has gradually normalized after the post-COVID excesses. The environment is no longer defined by emergency support, nor by abrupt tightening, but by a more stable and more selective market regime. What is changing is not the direction of policy, but the way markets respond to it. The period where liquidity alone could lift all assets is fading. In 2026, performance is increasingly driven by fundamentals, earnings quality, and balance sheet strength rather than by broad policy impulses. This shift sets the stage for a market that becomes less forgiving, more discriminating, and far more sensitive to execution. The backdrop against which the 3R framework for 2026 takes shape after the 3D of 2025. First R, resilience. What stands out today is not how fragile the global economy is, but how resilient it has become. The US economy continues to outperform expectations, supported by a labor market that is still somehow solid, rising real wages, and a clear productivity boost linked to artificial intelligence. Europe remains structurally slower, but it avoids recession thanks to fiscal support and targeted investment, even as growth stays uneven. China is no longer the engine it once was. Yet it is stabilizing through selective stimulus, exports, and industry policy. At the same time, emerging markets, especially India and parts of Southeast Asia, are moving from cyclical plays to structural growth stories. This resilience is no longer accidental. It's been engineered. The second R is repricing. The world of free money is behind us. Markets now have to function with positive real rates, higher term premia, and higher risk premia. Bonds are no longer dead assets. They are becoming income generators again. Equities can still rise, but not through multiple expansion, only through earnings delivery. Real estate is not collapsing, but it is repricing around leverage, funding costs, and quality. And geopolitics is no longer a tail risk. It is now a permanent feature of valuation. In 2026, mistakes in pricing risk will be exposed much faster than in the past decade. And last but not least, the third R, reallocation. This is perhaps the most underestimated dynamic. Capital is moving, quietly but decisively, away from extreme concentration in the US mega-cap growth towards industrials, infrastructure, defense, energy, and selective cyclicals. Away from a purely US-centric world towards India, Asia-Pacific, nearshoring economies, and strategic emerging markets. Away from financial engineering towards real assets, productivity, and security of supply. Artificial intelligence sits at the heart of this reallocation, not as a bubble, but as a capital-intensive supercycle. Data centers, semiconductors, energy networks, and cooling infrastructure are absorbing massive amounts of capital. And the real constraint is no longer funding, it is energy availability. That is why energy, utilities, grids, and raw materials regain strategic importance. So what does this mean for investors in 2026? This is not a year for complacency. But it is not a crisis year either. It is a year of discipline, of conviction, of active allocation. Returns will come less from market beta and more from correct positioning. Volatility will remain structural, dispersion will increase, diversification will matter again. In short, 2026 is the year where strategy comes back to the center of investment decisions. And in a world defined by resilience, repricing, and reallocation, the 3R framework is not optional, it is essential. Thank you very much. Have a great week, stay safe, and keep on winning.